Yeah, I'll go ahead and kick off. Yeah, this past couple of weeks has been very volatile, of course, for the stock market after the invasion of Iran. And from our standpoint, I guess first of all, the market's down this year. The Nasdaq's down about 3%. The S&P 500 is down after today's loss is about 2.5%. The good news for us is that we are up, and it's kind of a testament to, of course, our higher quality stocks. So it's more of a refuge. We always invest in a more boring way. And anytime you're investing, obviously last year was a terrific year. We made about 20%, driven primarily by our international stocks, which were up about 37%. So it was really a banner year last year. And of course, most of us will kind of hit that high water mark and see that high water mark and kind of lock that number in our brain. Maybe, your portfolio is at 2 million and then you see it go down a little bit. Even if we're up for the year, at one point I think we were up 9 or 10% on the year. And now we're only up, say, 4.5% or so on the year. So the good news is we're up. And I would take, if we could end the quarter up 4%, if I could make 4% a quarter and make 16% on the year, I think just about any of us would take that and run, and certainly we've had a really nice, successful few decades. We just turned 29 years that I've been doing this, and we've had 8% returns over the last 15 years, more than 9 the last 10, and 7.5% since inception, including all the crises that we've been through over the last few decades. And there's certainly been a lot. We've had Gulf War after Gulf War. We've had a financial crisis. We've had real estate bubbles. We had oil sell-offs, and then we had COVID. And now, you could throw the Iran invasion in there. And I'm not going to debate, having a son at the Naval Academy and discussing these things. And my good friend, General Borg Schulte, is the superintendent of the Naval Academy. And it becomes very real and very personal when you have friends in harm's way or children in harm's way too, serving overseas. So from that perspective, I try to remove myself from the political situation and look at it simply as a cold-hearted economist, right? And look at it from the terms of how do we make returns in any type of environment that we've been in. And if you look at our history, slow and steady wins the race. We've been through this before. And we've been through massive oil issues. And right now we have oil spiking all over the place because investors are trying to figure out how long this is going to go. And oil spiked up on Sunday, the futures to $119 a barrel, came crashing down when Trump said, this thing's over. And then investors realizing it's probably going to be a little bit longer, went over $100 a barrel today. So the stock market's kind of going inversely with oil. As oil prices are going up, that means the Fed's not going to be able to save us because we have higher inflation. And that has driven the market lower, with the exception of, some energy companies or some of the stocks that some of our clients didn't even like Lionel Basel or Dow, have just shot up massively this year. Some of the chemical companies. And I'm glad we own them. Even today, our best performers in a down day. And again, the market was down about 2% today. The Nasdaq was down about 2%. The S&P down about 1.5%. We were down about 1/3%. We really held up very well and holding up most of our gains that we've had so far this year. But even if we were down, the thing about investing is when you buy something, you're buying it for the next 5, 10, 15 years. And I'm in the only business when everything's 20% off, nobody wants it, right? It's sort of it's unnerving when things go down 20% and people don't want them. But our income doesn't change. So my revenue, because I get paid based upon your portfolio values going up. So on a year like last year is great, or a year like this year where we're still up, it's good for us or our firm, and you feel good because you see your portfolio values higher, but your income doesn't change. So if you're like me and you don't need the income, and you're taking all those dividends and we're reinvesting them. We're reinvesting them in more shares of the stocks that are lower. Or if you're retired and you need that income, you're simply taking the dividends from Nestle, from Procter and Gamble, from Pepsi, and just using them to fund your retirement. And as long as you don't exceed that 4% a year, our team, I think I see my daughter on here, Hannah, and our team never has to sell a share of Nestle or Pepsi to meet your retirement needs. And again, it's a very boring way to invest. I mean, I could throw all of our money in Tesla and hope it goes up. But we don't invest in hope at Altrius. We invest in cash flow. And as long as earnings are holding up, and the good news is that earnings are holding up, we're fine. And our companies have been through these type of crisis before. This one's a little different. Everyone is a little bit different. I was texting my kids earlier this evening and saying, unless you have boots on the ground, you really can't win a war. You need boots on the ground in order to meet the objectives that are being met here. But I don't think America nor Trump have the desire to put boots on the ground, because I've lost too many friends, and I don't want my son to go off to Iran anymore now either. So it's how this all plays out politically. It's probably not going to be very long, but how long it's going to take. Iran has their playbook. They know that the longer they draw it out, the better off they are. They have that Strait of Hormuz that they can mine and do things to, disrupt the global price of oil, and know that, the world doesn't like that, to try to keep themselves in power. So I don't suspect this is going to go on very long. It's going to be more of a containment type of issue. But while this does go on, we're going to have this continued volatility. At some point, though, the market will look forward. Trying to time that is imperfect, right? We're never gonna jump in and out of the market, and because we can miss a lot of the upturn if we'll miss a lot of the upturn if and when the market starts to look forward. So even if we were to go negative this year, which again we're still up a nice 4%, our U.S. stocks are up. As of yesterday's close, we were up over 8%. Our international stocks up over 5%, and our bond portfolio is up about 0.5%. So we're doing well from the standpoint of again up over 4%. We gave up a little bit today. Our U.S. stocks were basically flat today. Our international stocks were down about 0.8%. I believe, Brady, you said. I think we were down about 0.8. That's a lot better than the broader market averages, right? Again, the S&P was down a lot more, about 1.5%, and the international markets were down about 1.6% or so. So our higher quality stocks are holding up much better. Now, our strategy going forward, though, always remains the same. If you remember one slide, remember this one, that our income's always been there for our clients, especially retirees who are taking it. And if you're like me, we're just reinvesting those dividends and buying more shares as stock prices go lower. As far as the tech stocks, which are getting hit right now, and the AI revolution that's happening, AI will change the world much like the internet did in the dot-com bubble. When that bubble burst, the NASDAQ fell about 80%. I don't know if the NASDAQ's going to fall 80% this time, and how AI is going to change the world. I don't know what companies are going to change the world. I have a pretty good feeling that you and I might still be drinking Starbucks coffee, though, and we still may be using Exxon oil. We still may be eating, Heinz ketchup. So that part of our strategy, when we can look out much further, is much more stable than trying to guess which technology is going to disrupt the world and which company is going to be able to disrupt the world. And when you look at these companies, some of which we've owned in the past, like Apple or Microsoft, they are so richly valued right now that we really can't own them, nor are they paying very large dividends. So we're staying away from, and they've become just behemoths. One of the reasons why we're up this year while the market's down is we don't own these stocks. and they're all, it's a circular kind of financing going on right now where Nvidia is lending money to one company that's then buying Nvidia's chips. It's very reminiscent to me of the dot-com bubble. And actually, I liken it more to the bubble from the late 1880s, when we had the railroad bubble of America and we had just, railroads are going to change America, going to change the world. But there was so much investment in railroad by big financiers like Gould and others, and they went bankrupt, and we had empty tracks all across America at that time, and that's what happened during the internet bubble. And again, this always happens, right? Technology will change the world, but it's very destructive when it does it. It's destructive to jobs as we do this. And but I think AI is going to take a lot of time. As you know, when you call a call center and you don't get a human being, AI right now just can't do it. And I don't know if they'll ever become sentient, where they'll be able to truly think. That's the unknown question, 10, 20, 30 years from now. But even robots are not going to be, I mean, I can't even get my stupid vacuum robot to not get stuck sometimes. Never mind make something complicated. So we're probably decades away from AI. And again, a lot of these chip companies, when you look at quantum computing could very well replace chips, and so that's where some of these companies that seem so dominant, they could very well get replaced. So the massive amount of the S&P 500 that consists of these handful of companies right now is very concerning to me. I mean, I started writing about this in my book many years ago, and it's just, it looked like it was we had the implosion in what year was that? 2020. We were only down in 2022. We were down about 4%, 3% in 2022. The market was down about 18, 19%, the S&P. I thought that was the beginning of the end for tech stocks. But then the AI revolution kind of came, massive amount of investment, which propped up that sector. And again, but because we've just been nice and slow and steady, that's why this is how I'm invested right alongside you. Our balanced strategy, which is basically 67% or so stocks, and the rest of it is bonds. It's 4-star rated by Morningstar. Should be 5, especially our performance. I don't know over the last 5 and 10 years, but I don't know how Morningstar rates things sometimes, but our performance has certainly been very, very good. The problem with the S&P, again, is very, very constant. You have to go all the way back to the Nifty 50 of the 60s to see a concentration this high. We don't even have that chart in here, but it's concerning to me to see the concentration we have in tech right now, and a lot of these companies. What you'll notice is if you look back, I mean, does anybody remember a company called Kodak, which in 1985 was, one of the larger companies in our country, and is gone now. And even during the tech bubble, and when you think of companies like America Online or Lucent Technologies or what happened to Cisco, it took 23 years for Cisco to get back to its high watermark that it hit in 1999. So companies are often disrupted, and people have are very short-sighted oftentimes, and they think like, oh, this company is going to change the world, whether it's Tesla or another, and they get excited about it and they dive into it. Whereas, we look much more for the certitude of cash flow and not investing in hope. And so we're avoiding a lot of those companies, which again is one of the reasons why we are up this year in a down year. And again, even if we were down this year, the cash flow is going to be there for you. Pepsi's going to pay you the dividends, so don't get concerned about it. I know that you may lock in a number, you may see a number like at the end of February, and your portfolio might be a little bit less than that, and you get concerned. But try not to. I always read the great Stoics every day. I try to read a little bit of Epictetus or Marcus Aurelius, and part of Stoicism is not letting your emotions get the best in you. And even though I'm an emotional person, I'm half Italian, half Sicilian, right? So, it's easy for me to be emotional. But when it comes to investing, I'm never emotional. And people ask me, like, what do you think the market's going to do right now? Or what do you think it's going to do this year? My answer is always the same. I kind of give the Polish salute. Being half Polish, I always go, I have no idea. I have no idea what the market's going to do in the short term, nor do I care. The only people who will get on TV and make forecasts are they're fools, and they're either as Warren Buffett would say, forecasts tell you more about the forecaster than they do about the future. People who think they could forecast the future, because so what I do and what we do at Altrius is scenario analysis. We look at the worst case scenario, we look at the best case scenario, and then we look at what's probably the baseline case scenario over a 5-year period of time. Not necessarily, and that all has to do with valuations, because ultimately three things matter when you invest. It's valuation, 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 right? What you pay for something always matters, and being disciplined about that is really important, and not doing what the herd does and chase whatever's hot, which is so easy to do, but it's important not to get caught up in that. So the worst case scenario, if we were to go into a stagflationary type of situation where we have high inflation, higher prices, especially now with the oil spike, if that were to be prolonged, and lower negative GDP growth, and everybody tightens up, right? You guys stop calling for distributions because you're not spending because you're worried. Businesses stop investing in capital, and they tighten up, and we could have a recession. And under that scenario, everything loses money. We'll see our portfolio values decline. Our portfolio is not expensive right now. We're selling at about 14, 15 times earnings, which by historical standards is not expensive. The broader market is very expensive. It's selling at a much higher multiple, higher expense ratio. So in a worst case scenario, we're gonna lose money, and that's where the cash flow is important. That's where we can weather it by just collecting the dividends and not have to be forced sellers like you are if you're throwing it in something and hoping it goes up. On the high end, we could do very well, especially international stocks. Nobody wanted to be an international. I could tell you, I sell to financial advisors. Just here in the Detroit area, there's about 80 firms that I call on that we sell our ETF to. That's what makes us different. We're a wealth management firm for you, in that, Chris and Max and Brady, we're out there helping you with your day-to-day problems, educating your kids and grandkids, getting you your retirement income you need, what types of insurance should you have, helping you with estate plans, helping you in this tax season right now, work with your accountants. We're doing all the wealth management, but we're an asset management firm also. And that's what makes us a little bit different than most of the wealth managers out there. We sell to the wealth managers, and we're selling them our ETF. And I can tell you, in looking at the 80 just here in the Detroit area alone, the average international exposure is about 3 to 5%. And I'm pounding my head against the wall, telling these financial advisors, you need more international diversification. You're only looking at the last 10, 15 years. And when you look at the last 10 or 15 years, I'll show you a slide later, or I'll skip ahead and show you now. The last 10 or 15 years has been dominated by the US market. So that's all these financial advisors know is this. They see this. And I haven't been able to get them to invest much in international, to buy DivD, to buy our ETF, because for whatever reason, they're blinded by the most recent returns in the U.S. market. And they missed last year's 37% returns for international. They completely missed it. And this year, international started out better than the U.S. market too. We're starting to see a little bit of a rotation. So I think you might see this jaws that you're seeing in this slide start to close where the international, because these are very long-term trends. If you were to ask me to make a bet, I would bet international outperforming the U.S. market over the next decade. Now we're keeping it equal. We're basically equal between our U.S. and international portfolios right now. I would say the same about growth versus value. Everybody was a Warren Buffett acolyte during the 70s and 80s. The bubble burst here in the tech bubble, and value significantly outperformed. But then the financial crisis hit, and we had 0% interest rates, and that allowed Silicon Valley and growth stocks to just super accelerate. But now we're no longer in a world of 0% interest rates. And I think you'll see value start to outperform again here, over the next decade after this 15-year outperformance for growth stocks. So, I think that it's important when you look at valuation to be very disciplined and look at the worst case scenario, look at the best case scenario, and then set our allocation that we're setting right now based upon our base case, which is why we're effectively, unless you have a specific risk tolerance that's very conservative or very aggressive, then you'll own the same stocks, but you'll own it in a higher percentage. But the great majority of us are invested right now. We're at about 67, 68% stocks, and the rest in our high yield bond portfolio. And I think we can do decent returns. With our bond portfolio, we did decently last year. I think we can do okay this year. But interest rates are lower and going lower if the Fed continues to lower rates, which I don't suspect they're going to be able to do too much this year if inflation stays high, especially if oil prices stay high. They probably won't be able to lower rates very quickly, if at all, this year. The good news is that inflation has come down, right? The CPI numbers come down. We'll get a PCE number tomorrow. But it's not great. It's still been my base case. I sound like a broken record to our investment committee team, is that I expect sticky inflation. I've been expecting sticky inflation for a very long time, and more sluggish type of growth. On the one hand, we have a great tax bill that was passed last year that'll put more money in our pockets, and potentially be used to spend. On the other hand, we have tariffs, which are a tax, and they keep inflation sticky. There's a lot of debate amongst economists that say, well, tariffs are sort of a one-time type of tax. One time, it's only going to increase the price once, and that's it. I personally don't think so. I think that they're continuous because businesses are always trying to move around, and it could be plenty of the companies right here in the Detroit area that are dealing with this. I mean, I had lunch with an old Naval Academy buddy yesterday, and he just says he does tool and die machinery, just making parts. So he'll make a part for like a wrench that a helicopter company needs to put it on. Well, his input costs are higher because he's got, the wrench costs more for whatever metal he's using it for, and so he's got to increase his prices, and there's only so much that he can pass on. His labor costs are higher, and he's able to shift things a little bit in the short term, but that pricing pressure, is not going to be a one-time and done type of issue. I think it's sticky and continues to be sticky well through this year and into new year, into the years to come. So I still expect sticky inflation. I don't expect that you're going to be anywhere near the Fed's target of 2% anytime soon, and that'll also keep. Because we have these higher costs and higher labor costs, that'll also keep earnings down some and keep growth down some. So I expect inflation to stick around right about where it's been, which is 2.5 to 3% throughout this year, and it could be a lot higher here in the short term if oil prices stay high too. The good news is expectations had been coming down for inflation, but now they're starting to increase again because of and when people see, the one thing, as a cold-hearted economist, I never care how people feel. I always care what they do. So it could be, the reporter going up to the person who's filling up their tank, and the person's complaining about it, but they're filling up their SUV while they're towing their boat that they're also filling up while drinking a Starbucks coffee. You're like, oh, okay, you're complaining about it, but you're still spending. So I always care what they're doing. But we're certainly starting to see the consumer to be getting pinched right now. The consumers, we're having more delinquencies on the lower end. The middle class is feeling this more. Retirees are feeling this more. And then the higher end consumers also starting to slow some of their spending because they're getting concerned about what they're seeing on a regular basis on the television. So, I fully expect that we're going to see, inflation to be sticky for some time, and that the Fed's not going to be able to lower rates anytime soon, and certainly not aggressively. The labor market has been good unless you're a young person. if you're my son, there's a lot of 20-year-olds, living in their parents' basements who aren't able to get jobs. I don't know if that's partly AI, partly increased productivity, or if it's also partly that businesses are just trying to keep their overhead low and not bringing new people in. And I don't know if that's going to clear anytime soon, too. I think COVID may have had an impact. I'm not really sure, but there's certainly a problem right now in that unemployment is relatively low, and it's holding up okay as far as job growth. It's doing okay, although it's uneven. Like the last jobs number was pretty bad. But if you look at over a 2 month period or a rolling period, it's not too bad. And so that we have to see more numbers to see how the labor market is going to hold up, especially if we have again higher oil prices here in the short term. So there's a good news, bad news type of scenario with the labor market, and it's okay. But it's really bad if you're a young person, especially if you're a young male. It's not a good environment if you're young and in your 20s right now to find work. It's hard. The savings ratio is back down towards, people have now, back during COVID when the government was paying us to stay at home, we had very high savings, and people weren't able to spend their money, and they were spending it on staples and things. Now they got back out and they're spending it on services and things of that nature. And airlines were doing great, and cruise lines were doing great, and people were complaining about it, but they were spending money. That could change very quickly too with higher oil prices, and we might see people, forego trips or drive. But savings has certainly been depleted and back down to more sort of, Americans, we're terrible savers. We spend a lot of money. We don't save a lot of money. And so it doesn't alarm me when I see a low savings ratio, but what is alarming is if we go through a recession, there's nowhere for them to go, right? They're living paycheck to paycheck. So that's what puts the economy still in a tough spot if we do have a protracted war. So the consumer is losing steam, but still holding up. And it'll be interesting to see in the coming quarters how they hold up during this period. Again, I don't expect Trump to have this war go on for too long. But if he's serious about winning it and serious about the objectives that he's laid out, that's going to take boots on the ground. That's going to take Marines on the ground finding enriched uranium. And I don't think the American public, after Afghanistan and after 2 wars in Iraq, has any, and again, I lost a lot of friends and have a son at the Naval Academy. I really don't want it either. And I don't think people are willing to go through that right now, and nor do I think Trump is. So I don't suspect that that's going to be the case. And again, I'm not going to debate whether or not it's a just war and whether or not we should. I was close to being a priest, and I did a paper once on St. Augustine and just war theory, and it's very complex and it's more philosophical. And as an economist, we could debate whether or not it's the right thing to do for global security. But probably containment is going to be the goal at some point when we decide to pull out of Iran. But the consumer is still hanging in there. And the one thing you can look at is nobody needs a new automobile. Our cars, I just sold my 2000 Land Cruiser that my son was using, had 300,000 miles on it, and the thing was still running. Nobody needs a new car, but we're out there buying them. They last long. They're great. I couldn't fit my F-150 in the garage here in Detroit, so I got a little Maverick, which is a little bit easier to drive around in the city. But nobody really needs a new car, but people are still going out and buying them. So it's a discretionary luxury, and that's holding up. And so that's a very good sign. And existing home sales with mortgages mortgage rates are not going to go back down to 3%. And so I think a lot of people are kind of hoping for that, but that's not going to happen. And inventories are still quite low though. So I think that, the good news with home sales is that they've picked up some, but I suspect that they're not going to, we're not going to see an explosion of new home sales. Not to mention that people need to remain mobile and need to move to different places. And we're seeing a great migration from, the blue states to the red states, simply because of taxes and because that's where jobs are being created. So people have to move, and younger people are having to stay flexible. So again, the same outlook: sticky inflation, decent GDP growth is our base case scenario, and that's how we're positioning our portfolios. The good news is corporate profits remain very, very strong. Now, that can be hurt again by higher oil prices. If these prices stay higher for longer, we could see corporate profits decline some. But the great majority of our companies that are paying you the dividends that they're paying have plenty of cushion. Their earnings could get really hammered and they still have room to pay you the dividends. So it doesn't concern me in the short term if they go through a little bit of pain, and companies will make the changes that they need to make sure that they're paying you the dividends they're paying, and to make sure that their net margins stay strong. So the good news is corporations are doing good things. Our national debt's very high. I know a lot of our right-wing clients are very concerned about our national debt. I have a blog on this from, if you're interested, from years ago. Is America going broke? There's no perfect answer to this. If you look at the companies we lend money to on the bond side for the bonds we own, they have about 300% debt to their income. If you're a young doctor and you make $500,000 a year, a bank will be happy to lend you 3 times that. They'll be happy to lend you money to buy $1.5 million home. So is America not borrowing enough? Maybe. Some countries have gone bankrupt with 30% debt to GDP, like Iceland and Ireland were certainly struggling. Yet some countries like Japan have had 200% plus debt to GDP and haven't had issues in decades, although their growth has certainly been stagnant. I prefer personally about a 50% debt to GDP, because that, from a historical standpoint, gives you plenty of room in terms of times of extremity when you need it to be able to go out and spend money, where at a time like COVID or a time like war, where America can go ahead and spend. Whereas when you're already at where we're at, it's harder to, borrow more money, because at some point people could say, hey, America, your debt is too much. Even our politicians can't screw up the US dollar right now, though, too, because we are the world's default currency. You can't use the ruble. You can't, China does not have intellectual property rights. The euro is, you got the, Italians and the Greeks fighting the Germans and the Poles, my two historical ethnic backgrounds, and they're just very different. So the euro, although at times will strengthen, and the dollar certainly been declining relative to the euro, which has helped our international stocks, except really recently. That the euro can't overtake the US dollar. So this is something where, just due to our natural resources here in America, we are very fortunate and blessed to have the resources that we have. So this is a debate from an economic standpoint. As a patriot, I could worry about it and you could worry about it. But as investors, global investors, it's not going to have any impact on how much Nestle chocolate is consumed in Latin America, or how much Pepsi is consumed in India, or Fritos or Doritos are eaten in India, or how much Tide is consumed in China, or Starbucks coffee for that matter. So don't concern yourself too much about this issue. I know that some of the news stations love to talk about this, and you'll see all kinds of things. As patriots, we can worry about it, but as investors, as global investors like we are, I wouldn't concern yourself with that issue. I talked about the growth versus value. We're obviously value investors, and I think you'll see a trend more towards value here. Again, I was probably one of the few values. We just got named 3-time or 4-time manager of the decade now for our U.S. value portfolio. It's probably one of the few value managers on the planet who had a 15-year track record that was better than the S&P 500. But that was at the end of 2022, after the S&P fell. And then, of course, it was you can see right here, boom, right back to growth. But I'm very concerned here that you could see this, especially this AI bubble, could significantly burst, and that's where we'll really outperform. And then, like a day like today, when we were only down 1/3% and the market was down, a lot more than that, 1.5% or so. Again, same thing. We're keeping a balance between international and U.S. Because frankly, international stocks are a lot cheaper than the U.S. market, which you can see here on this slide. So again, how are we positioning ourselves? Well, we're pretty equal weight between U.S. stocks and international stocks. Again, the financial advisors and wealth managers that we sell to, they have no international exposure, and I think they're making a huge mistake, and they've missed it. They missed it last year. They've missed, good returns this year too. But we're keeping this balance for you and I. And we always look at things. It doesn't matter where the company's headquartered. You can be a company like Eaton. Eaton's an Ohio company. But when America was taxing them too much and most of their revenues coming from overseas, they said, "See, America, we're going to Ireland, and we're going to Switzerland. We're going to a different country where just like we do here in America, if a state starts taxing us too much." I mean, Exxon just left New Jersey after 150 years and said, "Hey, we're going to Texas." Of course they're going to go. I mean, if you're regulating the snot out of them, and if you're taxing the snot out of them, they're going to leave. As soon as Elena goes off to college, Michigan's not that bad. It's only 4.5%, but I'm going to find a nice 0% tax, or maybe I'll move to Puerto Rico and save federal taxes too, right? I mean, people move to places where it makes most economic sense, and corporations do the same thing. It doesn't matter, countries that get too socialistic and too tax heavy, their growth is going to slow. But capitalism will find an outlet somewhere in the world, and we're finding companies, regardless of where they're headquartered. It could be Nestle in Switzerland, but they're selling across the globe, and that's where we're investing. Is where is the growth coming from? Where is the revenue by geography, not where the company's headquartered. It doesn't matter where it's headquartered. And so with that, I'll kind of wrap it up. Again, the big thing about our portfolio is that 4% golden rule. If whatever storm we go through, and again, we're up this year. It's nice being up 4% when the market's down. But even if we were down 4%, even if we were down 15%, the dividends and interest are there for you. And if you keep your distributions to around 4%, we never have to sell a share of the stocks that we own. And that's really good for your cash flow. And that allows you to kind of weather the storms, right? It allows you to get through those invariable periods of time when the market is going down, because we don't know when it's going to snap back either. Timing the market is a fool's errand. So we'll never try to time the market. We're always long-term investors. So with that, I'll throw it out to questions, which you can yell over by unmuting yourself, or throw it in the Q&A or the chat, and I'll see it here, and try to answer any other concerns that you may have if I didn't solve all the world's problems in 41 minutes. Or did I talk too quickly? Sometimes I do that. I try to slow down. I tried not to have a cup of coffee this evening so that I wouldn't talk too fast. No questions? I can't believe it. Tim, you always ask some highly intelligent question that I can't understand. You don't have anything for me?
No. I was racking my brain today to find you a stumper, but
Jim,
Yes, sir.
I know you say for your equities you're about 50-50 international and US.
Yes, sir.
But you expect international to do better. Is you kind of hedging your bet?
Yeah, we definitely are. It's the only time, actually, in my 29-year history, it was the only time we went equal weight. It was about 4 years ago. Usually we had more US than international, but it was just too compelling not to invest in international, and that's paid off really well for you and I, especially last year, right? So last year, 2025, international had a banner year, 37% returns for our stocks. And the previous year, international was down though. It was down like 4%. But in the previous year to that, it was up like 20 something percent. But if you look at it from a rolling period of time, it's definitely paid for us to kind of keep a balance between both US and international. And even if you look at our ETF that we sell to financial advisors, what you'll notice about it is that it's like, it's boring dividend strategy. And you can see it's 50-50, right? 50%, 48% international and 51% US. And you can see if you take the whole of all the stocks that you and I own, selling at about 15 times earnings, so really cheap compared to the S&P 500. And most importantly, again, it's paying you that really nice big fat 4% dividend yield, and again, the performance has been terrific. If you look at the performance of our stocks this year, it's we're up about 6.5%, 8% for our U.S. portfolio, 5% for our international. So it's done exceptionally well, and I think that this year, who knows which one's going to outperform the other, but international is cheaper, has a little bit higher dividend yield. So if you look at Anu's side of the portfolio, so Anu's our PM for our international portfolio versus Brady and I on the US side. I'm jealous of Anu's portfolio, right? Like we own Chevron and we own Exxon. But I like Total and British Petroleum better. We own Johnson and Johnson, but I'm jealous of AstraZeneca and the healthcare companies on the other side. And if you look at our Bank of America, our financial companies, like a Bank of America versus BBVA, which has been a really terrific company for us, or the international stocks, people don't know them as readily because we live in the United States. So we know Exxon, we might not know Total, the French oil company. But almost across the board, everything in Europe especially is cheaper than their American counterpart. So I definitely like our international portfolio a lot, although this past week, international stocks tend to be more volatile. So there was one day just last week when international stocks were down 5% because you just have this puke out where everybody's scared, sell everything, don't think, and that happens. I don't worry about that in the short term. It makes me sick because I know that you're worried about it. And I have the illness of being like the anti-narcissist. I'm an empath, I guess, so I feel your pain. When you're feeling it, I feel it, which is why I have this event. I'm like, I know people, we have 35 people on this event tonight, and I know people are nervous right now. So that's why we have this and kind of discuss our strategy. And but we'll get through this just like we've gotten through all the rest of the things that we've gotten through over the last 3 decades together, and the key is the income is always there for us. So, and especially again, from those international stocks right now, we're definitely getting more from our international stocks than we are from the US portfolio. Did I answer your question, Al?
Yep.
Hey, Jim. So are we at 6.5% difference from the S&P year to date?
We're at what? The S&P's down 2.5% today. We're up about 6. So we're outperforming the S&P by about 8.5% this year. We're really outperforming it. Now you can't eat relative performance, as we say in the asset. Like if we were down 10% and the S&P was down 30, and we're outperforming by 20%. You're still nervous because you're down 10%. And that's why I like cash flow. That's why I like dividends, because you can't eat relative performance. But it is really nice when we're up, building on last year's 20% returns, with solid returns that we've had this year too. But again, day to day, it can get wiped out very quickly. We could have a bad couple of weeks and we could be down 4% by next week. I never know what the market's going to do in the short term.
Right.
But But
Makes
I do
sense.
know Pepsi's increased their dividend for, you know, I don't know how many decades. They're going to pay their dividend. You know, you look at Procter and Gamble during the financial crisis. What did they do? Raise their dividend. What did they do during COVID? Raise their dividend. You know, and those are the kind of companies we love. 85% of our companies again increased their dividends last year, and that's great. You know, that's what this chart's showing is that income just continues to go up, especially if you're reinvesting those dividends. That just increases your portfolio value. So yeah, the portfolio values. I mean, this looks like a blip. This was horrific in 2007, 2008. This was a huge sell-off, you know, for our portfolio. But look at the income, right? Our income didn't change, so our clients were able to weather the financial crisis, and the world was just imploding around us. Whether it was the real estate bubble, financial crisis, European crisis, sell-off, COVID was a 20% decline. Even our portfolios were selling off. I think we lost, I want to say 10, 12%. But what was I doing? We were 50-50 stock to bond at that point. I went in significantly into stocks because everything was on sale. Nobody wanted to buy. It was kind of like international stocks this year. Every prognosticator you saw on CNBC and Bloomberg was saying, no, no, just buy Tesla, just buy the big tech stocks, don't buy international. They missed 37% returns last year. I literally every morning am swearing at the TV when I'm working out at 6 o'clock in the morning, just shaking my head saying, you're a moron. You're just doing what everybody else is doing. But for me, it's all about slow and steady and getting you cash flow so that we can weather whatever's around the next corner. Because it's never the thing that you see. You know, people, that's another stoic thing is like, why worry about all the things you worry about? If you didn't worry about them, that never even came to pass, you should have realized, you know, and that's part of that exercise, right? You sit there and you're like, okay, what am I worried about? It could be a loss of your portfolio value. And then you realize, oh, I worried for nothing, right? And so it's usually the thing you don't see coming, like COVID, that hits you, that you should have been worrying about, that you didn't see coming anyway. So you know, you try to set your allocation based upon valuation and where the opportunities are, where other people aren't going, and that's the best way to invest, and that's the best way to survive when you have these invariable recessions that you go through. Again, my base case is not that we go through a recession this year. I don't think we're going to have a recession. Everybody's throwing the stagflation word around. I don't think we're going to have you know, massively high inflation and negative growth. I don't see that happening. It's possible, but it's not probable.
I think you said you think interest rates will stay kind of in the range they're in now?
I do. I think the Fed's not going to be able to because I think inflation has been sticky. I don't think the Fed's going to be able to lower rates very aggressively, especially because of the higher oil prices, which will also be, even if the Strait of Hormuz opened up today, it takes weeks to get that oil flowing again.
Yeah.
So I think inflation will be with us, and I don't think the Fed's going to be able to lower any interest rates anytime soon. So and that the 10-year rate has been pretty steady this year, and so mortgage rates are not going to go down significantly either, in my opinion.
Yeah.
Which is why I like stocks, by the way, over bonds. So Zach's portfolio, you know, Zach's been with me for 14 years. He's been the portfolio manager of our fixed income portfolio, and I made him that 5 years ago. He's done a terrific job for us. We're always trying to buy bonds that are getting 2 to 3% more than a riskless treasury, and we've done that. You know, if you look at our portfolio over the last 20 years, we've beaten it by about 2% a year. But high yield bonds tend to be more volatile too. They tend to bounce around. But right now the spreads are thin. You know, we're only getting about 5.5% return. So when I look at Zach's portfolio and go, he's only getting 5.5. We got a dividend of 3.5 to 4. I only need a little bit of growth to beat his portfolio, which is why we're at 68% stocks right now versus, if I thought that our stocks were overvalued and I saw that he was able to get a 10% rate of return, then we would shift more towards the bond portfolio. But I'm not seeing a lot of great opportunities in the bond market right now, nor is he.
So Jim, it's Paul. Thanks for steering the ship during these stormy weather periods that we're in. Doing a great job.
Thanks, Paul.
Given the sell-off, I mean, historically we're still quite high. Do you see where are we looking right now for the next value? What sector of the economy, or are there any specific companies that you think may have been oversold that currently present some value opportunities for us to get that 4% dividend?
Yeah, that's a good question, Paul. Thanks. And like, so Johnson & Johnson's a good example right now, right? Which you know very well. And if you look at our portfolio and you look at where we are from the standpoint of our sector exposure, what you'll notice is we're always playing defense and offense, and then tilting toward where we find things are cheap. Right now, I'd say healthcare is still cheap, right? Healthcare has not done great for some time. Mm-hmm. And you can see we're overweight. The S&P is probably only about 8%. And then our category, being more value, is at 14.5. We're at about 20% healthcare. And healthcare looks pretty compelling, relatively reasonably priced with a nice dividend. And then, of course, consumer defensive is in that same boat, right? This is one of the reasons why on days like today where we're not getting beat up. So the defensive sector, we always have a big chunk of our portfolio in defensive. And if you see where I've gone in and out of consumer staples, is when they start getting expensive, then we'll start selling them off. And then during COVID, before COVID, I was able to, we always have a watch list of things we want to buy. I'd love to buy Microsoft again. I can't wait to own Apple and Microsoft again, but they got to come down in price significantly, and that would increase their dividend yield too, for me to be interested in buying them. I don't think I'm going to get the opportunity. You can see we only have 7% in technology, right? And it's more of the boring type technology. Our industrials, I would say, was a fat pitch opportunity. Nobody wanted us to buy. I kept hearing even from our advisors, geez, why are we buying more Dow Chemical? Why are we buying more? And then clients, even last week, clients were like, hey, I want to sell Dow because that one's down. Well, if I showed you a chart of Dow and Lionel Basel this year, now, these are the stocks that clients were saying, the ones who watch really closely. They're like, look at all this red today, right? We were only down a little bit. Nobody wanted to buy Dow. And even my daughter, Hannah, there's a lot of times she'll say, Dad, you sure you want me to buy more Dow? Because she knows it's down, right? And we're lower in this particular, the companies that are getting beat up. And I apologize for my computer being a little slow right now. But these stocks this year, even today, our best performer with all of the red that was out there today, Lionel Basel was up another 10%, and Dow Chemical was up 9.3. Now, again, I'm contrarian and a value manager, so I want to buy stuff when it's cheap. And there's a lot of, now we've trimmed it. We were trimming it yesterday, so these positions have gone up so much this year. That Brady and I were looking at it, and we said, yeah, we want to trim our positions in Dow. And then we bought. What did we buy, Brady? We bought some of the stocks that were beat up. We bought more shares of.
Yeah, Boston Properties was one. Gentex, which is a consumer discretionary company. They make rear view mirror shields and electronics for inside your car.
Yeah, so those two companies, were a little bit more beaten up. So we're trying to stay equally weighted too. We're never going to take any big bets. It would be like you asking me which of my children I love the most, right? There's no way, there's no way you can do it. But look at look at Lionel Boswell and Dow. This is year to date, 71% and 61%. Nobody wanted these stocks. My own advisor is sometimes like, hey, a client wants to sell us. I'm like, talk them out of it. Do not, because this is invariably what happens is, especially if there's a lot of short interest in these companies, they get ripping. And that's what we've seen happen. So what do? Well, we just trimmed these yesterday. We trimmed them back down. And then as Brady mentioned, we were buying more shares of Gentex. We'll probably buy a little bit more Bank of America because financials have gotten beat up. I'd like to buy some more financials if the price gets beat up more. We might buy like a PNC. We bought Huntington Bank last year. But we're on the offensive side, we've got our industrial portfolio. Of course, energy is sort of like an offense and defense, right? Because now the price of a barrel of oil goes up 9% today. Exxon doesn't go up 9%. It might go up 1 or whatever was up today. Chevron was up 2.7. So it's not going up directly with the price of oil. But it does provide us, like Devon was up today, 1.8. So British Petroleum was up 1.5%. Phillips 66, which we own, you and I own, was up 2.7%. So the energy is playing, even though it's in the sensitive category for us right now, it's actually quite defensive for us because it's providing a hedge against the higher oil prices. So if you look at our portfolio, we basically have half in defensive, right? Our consumer staples, our healthcare, and our energy, and then the other half is in our cyclical, the financials, some tech, industrials. But yeah, we definitely, to answer your question, Paul, too, there's a lot I'd like to buy, in particular in the tech sector, but I probably won't be able to buy it unless we see a significant sell-off of like 20-30% in the tech sector.
Thank you.
Yeah, thanks for the question. That was a good one. You always ask good ones, Paul. You do better at the dinners, though. After a couple of glasses of wine, you ask me even tougher ones.
Looking forward to New Bern. Yes, coming up.
Yeah, the wine is free in New Bern, so yeah.
And any further thoughts? I know one of your previous comments about gold or these precious metals. They don't create jobs, they don't pay a dividend, but given these geopolitical non-stop events, any revisiting of that or potentially just a hedge, be a bit defensive?
We looked at the gold miners pretty significantly last year, and they were pricey at the time because it's kind of like selling the picks and axes, right? I don't want to be mining for gold. I'd rather be out there selling the alcohol and to the miners and the picks and the axes and stuff at the bar. So I for us, I'd rather own gold miners if we were going to own, but they got so pricey, and we missed the upside because it absolutely zorts, and then it went parabolic. And anytime you see something like silver prices going parabolic, you want to stay away because that can end very, very badly. And the gold has always been for 100 years the price of a nice man's suit. And if you went to Nordstrom and got a Canali suit, you'd spend a couple of grand, maybe $2,500, maybe $3,000 on a really fine suit that you didn't buy on eBay. And right now, gold at 5,000 is very pricey.
You get two of them.
Yeah, you can get two right now. So it's too expensive. Gold is too expensive. And and I actually did the math on this years ago, probably 15 years ago. If you melted down all of the gold on the planet, you'd have a cube that was like, I don't know, 80 feet by 80 feet by 80 feet high, whatever it was. And what that equated to was owning 7 or 8 Exxon Mobils, all of the farmland in America, and $1 trillion of walking around cash. And which would you rather own? Now, I asked our own staff, I said, hey, Brady, Nico, I did the math on this 20 years ago. You guys do it. And Brady, what did we find? We found it was like $2 trillion of walking around cash, 20 Exxon Mobils, and all the farmland in America or something, right? Because gold has got, was that about right when you guys did the math on it?
I think it was easily double those numbers.
It's crazy. So the valuation right now, and gold is completely useless, right? I mean, it doesn't produce any cash flow. It doesn't, it doesn't do anything. It's like I mean, it has some potentially industrial uses sometimes, but it's kind of like a work of art. If you have a banana peel on the wall and somebody's willing to pay $100,000 for it, $1 million for it, how do you value it? I always value things based on cash flow. So it's easy to, we bought more shares of Boston Properties because the stock is down. We think people still have rental, Class A space in New York and Boston and Washington, D.C., and we're getting an 8% dividend yield on it. And the cash flow looks good to us and we can analyze it. Analyzing a commodity like coffee, it'll just over long periods of time, it'll provide a hedge against inflation, and it'll go up at about whatever the inflation rate is. So gold will go up at 3% a year over long periods of time. Now it's gotten so far ahead of itself that there's a lot of downside risk and very limited upside potential. And I'd say the same thing for crypto, where people were calling it the liquid gold or alternative gold or digital gold. It's clearly not gold because it's down 50%, right? It was at 120,000, it's down to 60,000, and now it's 70. So it's not gold. It's not a currency because it's not a stable store of value like a currency is. It's not a means of exchange yet. It could become wampum, right? It could become like the early Americas where we're exchanging it like we do, maybe if everybody accepts it. But I would say that a currency also has to be backed by a taxing authority of a nation. So what is crypto? It's not cryptocurrency. To me, it's crypto token. It's just pure speculation. And really, if you look at crypto, it basically goes with the NASDAQ, right? It's kind of this risk-on type of asset that nobody really knows what it is, and so I would be very, I'm not going to put any of our money in something that's just pure speculation like crypto tokens or and to me, the only time I buy commodities for us, and usually commodity companies, is when I think we're going to have high inflation, and I don't think we're going to have hyperinflation. I think we'll have sticky inflation at about 3%, but I don't think we're going to have 8, 10, 12% inflation. So I don't think we should own commodities at these prices.
Mhm.
I mean, I got some gold, like some gold coins. I think that somebody gave me years ago. They're sitting here. If I handed them into one of those dealers, they probably give me half of the value of what it's worth, and you have to pay different people. I never want to own gold. I want to own companies. I want to own things that are growing and pay us something instead of just sitting in my drawer.
Yeah, creating jobs, all of it.
Yeah, it's like my Mickey Mantle signed baseball. What's it worth? I don't know. It doesn't even have sentimental value, right? Because I didn't see Mickey Mantle play. My dad gave it to me. I just keep it on my mantle, So. Any other questions out there? I don't want to keep you up all night.
Well, let's see what happens tomorrow.
Yeah, it doesn't matter though. Tomorrow, just like today, as we used to say in the Marine Corps and the Navy SEALs, the only easy day was yesterday. Every day as you go forward is just another day. Market will be up, the market will be down, but over long periods of time, we've done remarkably well. Our portfolio is going to pay you. You're better off watching a good documentary, reading a good book than turning on the news channels, which only give you ulcers. So try to do your best to turn them off and watch a good movie or even a rom-com or something. Or maybe the Cartoon Network is probably better than watching Fox or CNN. So,
Yeah, good point.
All right. So I'll close out the meeting unless anybody has any other questions. If you do, though, don't hesitate to email me. As always, deeply appreciate your trust. I know that you're throwing a lot of this stuff at us, so we could take the worry off you, and we certainly try to do that. And let us worry for you, and enjoy golf and boating and traveling and time with your grandchildren and children, and we'll worry about managing your portfolios because we're thinking about these things and debating them every day. So we appreciate your trust over these many decades. Thank you.
Thank you, Jim.
Thank you, Jim.
And team.
Thank
All right.
you. All
Good
right.
night.
Bye-bye.
Thank you, Jim. Thank you.